Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is an attorney and also a CPA, and his name is Scott Hazlett.
Hi, Michael.
Thanks for joining me, Scott. Scott is a California attorney and CPA who practices in the areas of taxation, real estate, estate planning, financial problem resolutions, and 1031 exchanges. He's a certified specialist in taxation law by California State Board of Legal Specialization.
That's a mouthful.
Sure is. And he also is a qualified intermediary for tax-deferred exchanges. I don't think he's been doing as many exchanges as he once was.
You might be surprised.
Anyway, Scott previously worked with Pricewaterhouse, which is now PricewaterhouseCoopers, and has been a CPA for over 25 years. Has been an attorney for nearly 15 years, graduated from the University of Michigan with a degree from its business school, and from Taft University School of Law, and he has his own law firm. In a past life, more interesting, he was a sports writer. He covered Major League Baseball, National Football League, and other sports. How did you ever decide to get into public accounting?
Well, it was quite a road. Let's put it that way. Quite a trip.
Anyway, today Scott and I are going to be talking about a topic that's on some people's minds, and it is the sale of a residence. And unfortunately, some people are dealing with sales of residences that they don't have gains. We're going to be talking about that in a different interview, but today we're going to be talking about more of the situation where you've been in for a while and hopefully you still have some equity left in your home. And so the concern is, okay, what can you exclude, what can't you? Related to that, I'm going to say that this is a big area in the sense of tax law. There's lots of details here. We have a limited time, and so just be aware of that. We're just hitting some highlights. This is to be the beginning, we hope, of a conversation that you're going to have with your tax advisor or your attorney and CPA. And then go forward from there. So with that, let's get started with some questions.
All right.
Scott. Now, if I sell a residence and I replace it with another one, does that defer the gain?
Yeah, great question that's often asked.
It's amazing to me.
It's amazing still after all this time. In 1997, the law, up to 1997, the law was that you could, in fact, avoid taxes on gains, avoid gains, by doing what they used to call the residence rollover rule, which was the purchase of a replacement property for equal or greater value after you sold the old home.
Right.
Now that law has been changed. That is, the law, in fact, now is you sell the home and you compute your gain, and the law allows, in certain cases, an exclusion from the gain, exclusion from tax on the gain. For a married filing joint situation, joint 1040, you're going to see up to $500,000 excluded from the gain. And for a single individual or two single individuals perhaps that own a house jointly, they could get up to $250,000 excluded from the gain.
Yeah, and so those two could get $250 apiece.
They could get up to 500, right?
Yeah.
The other interesting thing is that even you see some situations still where gains exceed $500,000 or $250,000 depending on the circumstances. And in those situations, we still get the question, oh, I'd like to take that excess and buy another home and get rid of the tax on that, but that's not available to us. This exclusion scheme, which is a permanent avoidance of the tax, that's taken the place entirely of the rollover law that was in effect before 1997.
Right. Now, what about the idea of converting a house to an investment property, like a rental, and then doing an exchange later?
Well, that's possible. So, for example, if you bought a house to live in for $100, and then the property went up to $300 in value some years later, and then you converted it into a rental property, and let's say for fun it went up to $400,000. Well, there you've got your original purchase price of $100 and the $400 current value. If you sold it at that point, you'd have a taxable event, and in general, if it's an investment property, you'd have a taxable event and you'd have a gain of the $300. Now there's an interesting rule here about this exclusion. The exclusion rule provides that if you own and occupy a property 2 of the 5 years ending on date of sale, that you qualify for the exclusion. In general, there's some exceptions that are sort of obscure. But back to your question, if you have sold a rental property that was a principal residence for 2 of the 5 years ending on date of sale, it's possible that you have a sale of a rental which also qualifies for the exclusion.
Right.
So going back to my example, if I had a $400,000 gain or $400,000 sale price and an original base of 100, a 300 gain, well, a married couple would get up to 500 off on that.
So that would be the whole thing.
That would be the whole thing, and they wouldn't pay any tax.
Right. And so even with the exchange, basically would be an academic exercise for them.
It wouldn't even be, yeah.
But if it was a single person, let's say we got the 250,000 exclusion, he can still get the exclusion, and then he can defer the 50.
That's correct.
In that particular situation.
That's correct.
Okay. All right. Well, you sort of skated through a lot of things on my second question.
Go ahead and we'll talk about them again, because this is a very complicated question.
Yeah. Maybe I'll move ahead, because you've covered the 250 and the 500 exclusion, and then we talked about again the 2 of the 5-year rule. But how about now? What if the residence was acquired in exchange? There's a situation in the middle that we didn't cover.
So that's a flip.
Yeah.
There's a rule. The rule itself is found at Code Section 121. So I always call it the 121 exclusion rule for reference.
Okay, so that's an Internal Revenue Code section.
Right.
So some tax people are what we call code heads, and so they talk to each other in code.
Guilty is charged.
Okay.
Guilty is charged. So under 121, there is a subsection under D10. And it says that if you buy a property in an exchange, now let's think about what an exchange is. There's a sale of an investment property,
right?
And then if you acquire a replacement investment property and you pay enough for it, in other words, you sell this for 100 and you buy this for 100 or higher, then the gain is avoided and it's deferred, basically. Very similar to the old residence rollover rule.
Yeah. Now,
if the replacement property is a single-family home, let's say, it must be an investment property. It has to be a rental property, basically, at the outset when you first acquire it, so that you qualify for this exchange rule.
Right.
However, if the character changes, if, for example, this is, let's say, held as a rental for 2 years,
right,
which is there's no bright line test for that, but if it's held for 2 years, it probably will qualify. Mm-hmm. Then you move into the property as a principal home, occupy it for 2 years. Let's go back to our 121 rule. That says if I then sell it, I've held the property for 4 years, because I had 2 as a rental and 2 as a principal residence, and I've occupied it for 2 years. So I've met my general 2 of the last 5 years owned and occupied. Unfortunately, this exception under this D10 says you have to own the property for 5 years. So it was a loophole closer. That rule was put in 2004.
Well, isn't it that you have to have used the property as a residence for 5 of the last 10 years?
Well, no, it's use it for 2 years, but you have to own it for 5 from date of acquisition. So if you bought a single family home,
it's owning it for 5 of the last 10.
Right. So if you own the property, let's say you bought an investment property today on 1031 exchange, and you put it into rental service. So today is, what is it, April 19th?
Yeah.
April 19th, 2011. Hard to believe.
Day after April 18th,
yeah,
which is the tax deadline.
Exactly. So I'm a bit punchy here. So I can't use this special exclusion rule until April 19th of 2016, which is 5 years from now, even though I might live in it 3 years or so forth and so on. So that's an exception to the 2 out of 5 ownership rule from the 121.
So be very careful when you acquire a property in an exchange and then you convert it at a later time. And there are a lot of people that are real estate investors that do this sort of thing.
Yes.
And so that's the reason why we wanted to be sure to bring it up in this discussion. All right, now, what if the house is used for a non-residential purpose or as a rental?
Well, that's a very interesting question. So let's take And of course, this is very timely because now we've just sifted through hundreds of tax returns, and the question often comes up: office and residence. Well, I'm exclusively using the fourth bedroom because I'm an outside salesperson and so forth and so on. So I've got a 2,500 square foot house, and I've got 250 feet, and so it's 10%, and that's considered non-residential. That's considered business use. And then I sell my property, and I try to claim the exclusion rule. Well, there's an interesting benefit in the 121 rules, and it says that if you have a single dwelling unit, and even though you may allocate a portion of it to an exclusive business use, like an office and residence, or let's say you had a roommate, a rental roommate, somebody's paying you to live in there, as long as it's a single family home, that business use is disregarded for the purpose of taking the exclusion.
Yeah.
So it is of great benefit. There was some controversy about that. That was changed in a ruling that came in 2004.
Yeah, I think some new regulations IRS issued. Now, more recent development though is now, what if you live in the home for a while, and now you start renting the place out?
Right.
So you bought another place, for example, or maybe you were transferred overseas to work, or whatever, and so now you haven't sold the place, so you're renting it.
Right.
What happens in that?
Well, there's
scenario?
a couple of different rules. Let's talk about the situation where you, let's ignore the rental fact pattern, let's come back to that. But in the first situation here, let's say you bought a property today, and 1 year from today, your company transferred you to Phoenix, and you sold the property. And let's say you bought well, you paid $100 for the property, and it went up, say, $75. So now you've made a 75 profit on this, and we're talking thousands. So you sell the property. Well, the general rule says you have to own and occupy for 2 years to get the full exclusion. However, there's an exception that says if you sell the property because you had a health issue or a job change or certain other circumstances which are laid out in the regulations called unforeseen circumstances, in any of those cases, the law says that you can take the exclusion amount, the full exclusion amount, times a percentage of the 2 years you use it. So in my example, if you lived in it for a year, that's half. Mm-hmm. So if someone had an exclusion of 250, they would be permitted to have an exclusion of 125. Mm-hmm. And so for that example, they move to Phoenix, they sell the property, 75, but they're covered by the 125 exclusion.
Right.
Okay. Now the second example is a situation where you live in it, and then you rent it out. So I'm transferred to Phoenix, and I say, well, I've got a gain in the property, but I really want to keep it. I might come back, or whatever the case may be. And then you sell it later as an investment property. Well, now you haven't met your 2-year test in those same facts, in terms of occupancy. And the question comes, do you somehow qualify for that unforeseen or job change or health reason exception? And that's a really interesting question. It's a fact question. Am I just renting it for a little while to sort of mitigate cash flow, to try to sell it? Or am I really, did I change the overall character? If you change the overall character, then you probably don't get that exclusion. Mm-hmm. But this is a perfect example of why TurboTax will not be able to answer that question for you. You have to see a tax advisor. Mm-hmm. And in pre-planning as well. Hey, I'm thinking about doing this. Is this a good idea? No, not a good idea. Or yes, great idea.